Hello, I'm Mary Reed, National Director of Qualified Plan Marketing for Alliance Benefit Group Pentegra. We are a third-party administrator of qualified plans and currently administer about 3,500 plans. Our parent company, Pentegra Services, Inc., has been in the pension business for nearly 70 years. Together, our expertise and talented staff helps find solutions for clients. Welcome to our training series for financial professionals. In this series, we will use our expertise to help prepare you to find prospects and write qualified plans from closing to establishing the plan and further administration. Let's begin. Welcome to this session on tax advantage planning opportunities for business owners. There are so many things that business owners can do, but they have some unique tax advantages that you or I as an individual can't take advantage of. So we thought we'd put a few of them together here to try to give you something to think about. So let's talk about those. And on slide 3, you can see them listed. The first one I want to talk about is 412(e)(3) fully insured defined benefit plans. Now these are plans that have been around for many, many years. They kind of come and go in popularity, but they are great plans for employers. These are what used to be 412Is, now they're 412(e)(3s. They're fully tax deductible to the business. Everything in there will grow tax deferred. Everything in all the money in the plan is fully guaranteed. There will be taxation at distribution, but there also can be a tax-free death benefit provided by these plans if the employer chooses to have that. The second concept is Section 79. These are employee insurance plans, typically known as $50,000 of free term insurance, but they can also include permanent insurance. This is a unique opportunity for business owners. It enables them to buy life insurance on a fully tax-deductible basis. It's fully tax-deductible to the business. It will be partially reportable as income, as personal income, but it also generates tax-free future income and tax-free death benefits. The third scenario is something we're just calling Qualified Plan Max. This is a way to reduce taxation on IRA savings and other qualified retirement plan savings by positioning them in a way that will have less income tax applied to them. It's a strategy to reduce taxes on future income. Actually presently, so you don't have that tax in the future, and then in the future the income you pull down will be tax-free. It also provides tax-free death benefits. So let's start with the first one. Let's talk about 412(e)(3). These are plans that are permitted under Section 412(e)(3) of the Internal Revenue Code. They are defined benefit plans that are funded exclusively with insurance company contracts that qualify under Section 412(e)(3). All the funding of these plans is based upon the contract guarantee, so there is no market risk here. And they generally generate a higher deduction than a traditional defined benefit plan, and certainly more than defined contribution plans. So they're for employers who are looking for those big deductions and have the cash flow to be able to make those contributions every year. The great appeal here is that they have guaranteed returns, they can provide guaranteed death benefits, and the costs are very predictable. Also, everything here, if they have one rank and file employee in the plan, is protected from creditors, and obviously everything is currently tax deductible. All good things for that employer. Now, if we look at slide 6, you can see who might be a good candidate. Typically, these are small companies, usually fewer than 5 employees. They have high, stable profits. They have cash flow. An older owner, younger employees, they would like that high tax deduction. And they have the ability to make those ongoing contributions. And they have the ability to commit to this for 5 and maybe up to 10 years. So let's take a look at a sample case on slide 7. This is a typical case. We have an owner with 2 employees. You can see that if they did the plan but didn't include the life insurance, which they can do, it's annuity only. This must be a level premium annuity and an annuity that qualifies under the section of the code for 412(e)(3). You can't just use any off-the-shelf annuity. You have to reach out to companies that offer the appropriate annuities. The contribution could be $211,984, with $196,000 of that for the owner. If you added life insurance to this plan, the owner could get as much as $4.5 million of life insurance. This would be whole life. You can only have whole life in these plans. Now the contribution for the owner is up to $241,778. The total plan is $259,798. So you can see we're getting very substantial dollars here, big contributions, big death benefits. At retirement, the owner will have a lump sum in addition to the insurance of $2.3 million. The employees are along for the ride, of course. They also get insurance because when you put insurance on one person in these plans, you have to put it on all. But the employees are really not costing very much. The total employer outlay for those employees is about $18,000. Assuming they're in a 34% tax bracket after you take into account the deduction, it's only costing that employer about $11,900, and that's with $241,000 going to work for them. So it's a very nice strategy. Here you can see it laid out. The net after-tax cost of this plan on slide 8 is $171,027, but the contribution that's going for the owner is $241,778. Uncle Sam is kicking in the rest to help out. And the life insurance, if we did the plan without the life insurance versus with the life insurance, it's a difference of plan contribution of $47,814. So that would have to be put in to cover the life insurance premium, but the premium is being paid is really $141,309. And that's giving that owner that $4.5 million of death benefit, and the death benefits, the life insurance benefits for the two employees as well. But you can imagine if that business owner needed to pay that premium on a personal basis to get that $4.5 million of coverage outside the plan, how high their earnings would have to be to then pay the taxes and net the amount to pay that premium. You get tremendous leveraging in the 412(e)(3). So it's a great tax planning strategy for employers, very secure. All guaranteed, no market risk, very big dollars. You know what you're going to have at retirement. It's a great program for the right employer. So now let's look at Section 79. We're seeing more and more that a lot of Section 79 plans are layered on top of qualified plans, could be on top of a 412(e)(3) plan or some other kind of qualified plan. The reason for that is that a Section 79 is a life insurance program for employees. And we typically know it as the $50,000 free term insurance that employees get often at employers, but it can also contain permanent insurance. And so for the business owner, it's a way to buy needed insurance at a discounted rate, and the amounts of insurance purchased can be quite large. So let's take a look at how this works. The Section 79, we're on slide 11 here, is not just the group insurance for employees, but it can also provide permanent insurance. And you need a specifically designed policy for this for it to work. And what will happen is the premiums for the policies are 100% deductible to the corporation. Anything over the $50,000 term is reportable out and added as income to the insured's W-2, but only a portion of the premium. It's not the entire premium that's reported out. Typically, it's about 60 to 65% of the actual premium, which means you get to exclude 35 to 40% of that premium. 100% deductible to the business, not reportable out as income, so you get that great leveraging. Life insurance is 100% of what the Section 79 is. That's the only product that will be in there. And this is the only way for the employers to buy life insurance tax deductible other than a qualified plan. And here, unlike in a qualified plan where everything, the cash value of the policy would be taxable when it comes out at the end, because everything in a qualified plan is taxable at distribution, the beauty here is it's not 100%, it's 100% deductible but partially reportable up front, so you don't get quite as good tax deduction, but everything that comes out at the end will be income tax free. So that can give it's a great cash accumulation strategy. As I said, all the premiums deductible to the corporation, partially reportable out on the W-2. They're using Table 1, IRS, the government Table 1, to figure out that value. But you have to have the products that work properly to make this work so that the amount that's reported out is where you want it to be. Now, keep in mind, these are personal life insurance policies. They're just being paid by the corporation, so they belong to each individual. And eventually they will accumulate quite a bit of cash that will be available as tax-free income drawn out via policy loan. So what are the benefits for the owner? Let's look at slide 13. The death benefits, just like any life insurance policy, can be used for family survivor needs, could also perhaps be for estate tax planning, could be any number of reasons that person has a personal need for life insurance. The tax benefits to the business are, for the company, it's 100% deductible. As an employee benefit, it's a nice, attractive employee benefit, an added benefit to give employees. to give them a life insurance benefit, which is pretty hard to come by at employers right now. And as I already said, the policy cash values, that policy belongs to the individual, so they can provide additional retirement income later on. And that's why these are often sold in conjunction with qualified plans. Qualified plan, 100% deductible up front, fully taxable at the back end. This is going to be 100% deductible, but partially reportable up front, but entirely tax-free when you take it out the back end. So it gives good tax planning diversification. So who's an ideal prospect for this? We need an owner-employee of a C corporation. This must be a C corporation in order to get the deduction. Also, a prospect might be someone who's not an owner, but they're a key employee in a business where they would take this idea and maybe open the door in that business that they might want to adopt this. Ideally, we want people between ages of 35 and 55 because they're most likely insurable. And also, it gives them enough time before they're going to want to draw that money out for retirement for that policy to build up the cash value. Typically, their income will exceed $200,000, that they'll have the cash flow and the desire to want this sheltering and to make it happen. They have a need for life insurance. They're motivated by the income tax advantages. This may be in addition to a qualified plan that they've already maxed out, or maybe instead of if the qualified plan doesn't work that well for that business, but you certainly can layer these plans, and that is frequently done. And they're able to commit to a significant amount of annual premium for 5 years. This is a 5-pay policy typically that's used, so they're paid for 5 years and then they are done, but they have to be able to pay for 5 years. So on slide 15 we see a sample case here. Here we have an owner based upon their salary. They could pay a premium of $100,000. That would buy them $2.2 million of permanent insurance. This is using National Life's product. There are 2 companies that do this, National Life and Pacific Life, that we know of. National Life has excellent products. This is an indexed universal life product issued by Life of the Southwest, who is one of their subsidiaries. This policy generates $2.2 million of death benefit for the $100,000 of premium. They would have to pay that $100,000 for 5 years. But notice what's reported out on their W-2 is not the $100,000, it's $62,298. So they're getting the leverage of getting a deduction for $100,000, but only having reportable value on their income of $62,000. So there's your spread, and that's where the leveraging is. Now, each of the employees here could choose that same option, but then that would cost them something. For example, if you look at employee 1, if they took the death benefit there under option 3, the $478,500, and they took the permanent insurance, they would have added income on their W-2 that would be taxable of $12,754. That may or may not be worth it to them. At the other extreme, if they just took the $50,000 term, there'd be nothing added to their taxable income. It would cost them nothing. The premium for that would be $177, and that would be paid by the corporation. So ideally, this is what the business owner wants. He wants the permanent insurance and hopes all the employees take the $50,000 free term. If they did that in this scenario, the total contribution that the employer would pay would be the $100,000 for their policy plus the accumulated amounts for that term insurance for the employees. So it comes to $100,595. The corporation gets the full deduction for that. Reportable out on the owner's personal income taxable is $62,298. Getting the benefit of $100,000 of premium, only paying tax on the value of $62,298. It's a very nice deal for that business owner. The third scenario I want to talk about, qualified plan max, is not a way to put away money, but it's a way to get the money out of those tax advantaged vehicles, hopefully in a favorable way. It's all about repositioning funds that are currently contained in qualified retirement plans or IRAs and moving them out in a way that will protect them from any future tax hikes and hopefully get the tax as low as we can. This would be for IRAs and qualified plan accounts. Now it's great. Lots of people have IRAs. There's wonderful things about IRAs. For most people, depending on your income bracket, contributions may be full or partially deductible. All the earnings grow tax deferred, and there's no taxation until they are distributed. And certainly over the years, lots of people have put money into IRAs, and they're hoping that they'll be in a lower tax bracket when they take the money out at retirement. Of course, at this point, we don't know whether that is true or not. Now there does come a point. There are some issues they have to deal with when money's in an IRA. On slide 18, you can see if you take your money out prior to 59 and a half, as we all know, you'll have to pay ordinary income tax plus a 10% penalty unless you've done what's called a 72T, which we won't get into right now. So if you're forced, you need that money, you might be paying extra tax. Assuming you didn't have to pull it out, you let it sit in there, eventually you're forced to start drawing it out at age 70 and a half. And the distributions must come out based upon life expectancy. You will pay tax on, the person receiving the income will pay tax on that at ordinary income tax rates. And you must take those required minimum distributions, because if you don't, any failure is taxed at the rate of 50% on the amount that should have been distributed but wasn't. So IRAs have some great features to them, but some things are not as wonderful. And I've talked to a person who has an IRA who's very aggravated that they have to start pulling that money out when they're 70 and a half. So here's another option for people. You could roll those IRA funds over into a profit sharing plan. Now let me preface this by saying you have to have a profit sharing plan. So this would be a solution for someone who's in a profit sharing plan that would allow this, or who has some kind of earned income and would be able to establish a profit sharing plan for themselves. They'll probably be the only participant, and that's fine. Once you have a legitimate profit sharing plan, it has to be legitimate, IRA funds can be rolled over into the profit sharing plan. Now, once in the plan, those funds can be used to purchase life insurance. There's a particular policy, and this does not work with just any policy. There's a particular policy we know of that's issued by National Life that works very, very well here. It's the same product they use for that Section 79 plan, and it can be issued in profit sharing plans. So it is it's the same policy, which means you're going to pay the premiums over 5 years. Let's say someone rolled over $500,000. They could pay $100,000, $100,000, $100,000, $100,000, $100,000, 5 payments. That policy would be paid up. It's in the profit sharing plan. And now what you want to do is distribute that policy from the plan. That will be a taxable event, which makes most people cringe, but it will be a taxable event. But the reason you want to do that is that because of the nature of that policy, when the policy is distributed, it has to be distributed at market value, which I'll talk about in just a second. And with this particular policy, the market value will typically be about 60% of the premiums paid in that 5th year. So in my example, let's say if you had put in $500,000, you put $500,000 in. Now, if you had just drawn that $500,000 out of your IRA over time, you would have paid tax on all $500,000, plus if it had added any additional earnings in the meantime on that as well. Here, we put the $5,000 into the policy, distributed the policy, and you're going to pay tax on only about 60%, or let's say $300,000 instead of $500,000. And now you have a personally owned policy. All that cash is in there. It's going to build value, and you'll have that policy available for tax-free income in the future. So how can that be? Well, let's take a little closer look at how this works. Keep in mind on slide 21, we never want to violate the incidental rules here. It's a legitimate profit sharing plan. There have to be contributions. We can talk to you about that if you want to call us. Legitimate plan. We're not trying to do anything shady here. And the incidental rules will apply, but rollover monies are not subject to the incidental rules and can be used fully for paying premium. If the person's been a participant, if you have an existing profit sharing plan for more than 5 years, there's no incidental limits. If you're within those first 5 years, once you get past the 2-year mark, any money more than 2 years old is also not subject to the limits. So there's lots of flexibility here. The typical client who does this, historically that we've seen, typically rolls in $600,000 or more to use this strategy, just to give you an idea of what kind of clients are thinking about this. Now, the key here is that what does the policy get valued at when it gets distributed? And there used to be a concept like this that floated around for a long time, and people used to use something called springing cash value policies. You put a lot of money into a policy, somehow it all disappears, you move it out of the plan for a minimal value, and then poof, all the money shows up again a year later. And the IRS was not too fond of that strategy because they were losing tax revenue. So in 2005, they came out with a revenue procedure to close that loophole. And based upon that procedure, after February 12th of 2004, when policies are distributed, they must be valued at fair market value. Not cash surrender value. It has to be fair market value. So what does that mean? The fair market value, there is a safe harbor that they created, and you can see it here on the slide, that it has to be the greater of A or B. And in this case, B is the larger amount, and that's what we're using, and this is frequently referred to as the PERC value. What it is, the policy is valued by taking the premiums paid plus the earnings and subtracting reasonable charges, and then you multiply that times an appropriate factor. I'm not going to get into the table now, but there's a factor. That is your PERC value. That is a safe harbor under the IRS rules, and that is a very valid and safe value to use. You have to look at different policies to see how their values calculate. This particular policy from Life of the Southwest, the Section 79 policy, because it's designed as a 5-pay policy and all the expenses of that policy in the first 5 years, it happens to have quite a low PERC value, legitimately so, under the safe harbor calculation in the 5th year, which is when you want to distribute it. The PERC value is less than the premiums paid, but it will generate sufficient cash values in later years to generate quite a nice income. In addition, there are living benefit riders on this policy that can also be very advantageous for the insured. So let's talk about the profit sharing plan. I'm on slide 24 here. As I said, you need a profit sharing plan to be able to roll that money into. It has to be a legitimate plan. So if you're setting up that plan for someone who has earned income, they have to have earned income, and they do have to make some kind of contributions to that plan going forward. We will help set up that plan. We will do all the installation, we'll do the documents, and we will do annual administration on that plan, including the 5500 reporting going forward. We will help coordinate the product issue and the service, and we'll help you through the whole process of getting that plan set up and getting everything properly done to make sure that plan stays in compliance. So let's talk about your clients. We talked about kind of 3 wealth management strategies here. You can use qualified plans and Section 79 plans to help your clients save current income taxes, save on future taxes, accumulate money and save for their retirement, protect their assets from creditors, attain substantial death benefit protection, provide employee benefits, and transfer wealth. You can use the Qualified Plan Max strategy to help your clients save on income taxes, have tax diversified planning, create some tax-free income for future retirement, and obtain substantial death benefit protection, and also, again, to transfer wealth. These can be very good strategies for business owners who have accumulated or want to accumulate quite a bit of wealth and have the planning strategy all the way through. So we thought you'd find these of interest. If you'd like to know more, just give us a call. We'll be happy to talk to you about them. Thanks for attending this webinar. If you'd like additional information, please visit our website at abgpentegra.com. You can also reach me via email at mread, that's R-E-A-D, like you read a book, at abgpentegra.com, or you can call me at 802-477-2018. Thank you.